Recently, the IRS released regulations for the high tax exception of GILTI. This new exception makes sense for quite a few reasons. First of all, GILTI in its name is supposed to be going after low taxed income. So if you're not paying a low tax rate on this income in a foreign country, it wouldn't make sense that something that's aiming to tax low taxed income should actually apply. Next, Subpart F income, which GILTI is a part of, the main anti-deferral regime, already had this exception for other types of income. So now it just puts GILTI in line with those that the high tax exception will also apply to GILTI. Lastly, due to 962 elections, if you were paying high tax in a foreign country, you could already make the election, take those credits on your return, and you wouldn't have to pay GILTI anyways. So really, there was a kind of indirect high tax election, but you had to go through the entire hassle of the 962. So now this makes it more formal. It's going to apply to income that pays an effective tax rate that's 90% of the corporate rate. So our current corporate rate is 21%, 90% would be 18.9. If the actual effective rate is that high, then this high tax exception will kick in and there won't be any tax on the GILTI. It's a year-by-year election. There was some talk at the beginning that it was going to lock you in for a certain period, but you can make it each year. The election is made for each tested unit. There's different definitions based on branches, countries, multiple corporations of what your tested unit is. So if you do have multiple places you're paying tax, you want to look through and make sure what your tested unit is. And the election can be retroactive if certain conditions are met. However, as I explained, if these conditions were met in the past, the taxpayer probably already made a 962 election and made GILTI irrelevant anyways, therefore there won't be much help from the retroactive part. And then an election by a controlling U.S. shareholder is going to bind all of the U.S. shareholders. Therefore, if you have multiple U.S. shareholders, you want to make sure they're on the same page before they do this. So what are the real benefits since the 962 election was already effectively eliminating your GILTI if you were already paying this rate of tax? The first one is that hopefully we don't need to calculate the QBAI anymore, which is the depreciation of those foreign assets. It's a lot of data input. It's a lot of work for the CPAs or the people preparing it. It's extra fees. It's extra information gathering for the client. And it's just become a real kind of difficult situation to get all of this together. Second is you don't have to go through the hassle of the 962 election, which creates additional forms, additional reporting, the modification of the 1118, and all that goes into that. So really what we're hoping from this high tax exception for many taxpayers is just to get some administrative relief and makes things easier. We haven't seen the reporting yet, but once we do, hopefully it's as simple as showing your effective rate, checking a box, or filling out one form, and then we don't have to go through all of the QBAI, the 962, and all of that. If in the end we do have to and they still want you to do everything and report everything and just show that the high tax exception applies, then in the end, for many, many taxpayers, this really isn't going to be much of a benefit since through the 962 election, they were already getting that. So stay tuned. We'll let you know once the reporting comes out. Hopefully it does make life easier for taxpayers and tax professionals in the future, but we're going to have to wait and see how the actual reporting shakes out.